Welcome back to the deep dive. So, a couple of weeks ago, we dove into a specific set of technical analysis charts
Hmm.
for October 2025, and we highlighted some names that looked pretty strong, showing upward potential.
Yeah, but the market, well, it doesn't really care about our plans from 2 weeks ago, does it? Those charts definitely don't.
Exactly. So today, we're doing something really vital. We're revisiting that list, kind of stress testing our original thinking.
That's right. And look, if we're successful today, it's not really going to be because we proved the stock picks were perfect. The real mission here is to illustrate, I think, the most crucial benefit of technical analysis, execution, and importantly, risk management.
Okay, risk management. Let's unpack that because I hear that, but for a lot of investors, it might just sound like, setting fancy stop losses.
Hmm.
How does the technical toolkit make this smarter than just, say, a generic 10% stop?
It's really about precision. The core idea, the rule, is we define the exact point where the thesis fails before we even think about entering the trade. And that's based on the chart's own history, its structure. So if the price violates that line in the sand, maybe it's the 50-day average, maybe a trend line that's held for months, or a critical swing. The chart is basically telling you, look, I failed the technical test. Please proceed without me.
Right.
You follow the trends as long as they work, but you absolutely have to recognize that precise moment the thesis breaks down.
Got it. So that sets our agenda pretty clearly. We're looking at 6 stocks. We've got 2 where the original idea is holding up, momentum's continuing.
Yep, the easy ones.
2 where, well, the results are a bit mixed, the story's kind of evolving.
Mm-hmm. Requires more thought.
And then finally 2 that are sitting right on these critical, do or die final support levels.
Make or break time for those.
Okay, let's start with the charts, where the trend is still very much our friend. The easier ones first.
Yeah, let's start with the wins, the trends that have kept going pretty much as we hoped. First one up is Johnson & Johnson, J&J.
Ah, J&J.
Yeah.
A classic defensive name, right? Mega cap, blue chip, healthcare sector. And that difference matters, doesn't it? Like when the market gets choppy, J&J often looks more stable than, say, volatile biotech.
Exactly. It relies less on hype, more on steady institutional money. The initial catalyst we saw was a really strong breakout after their July earnings.
Okay.
And the structure we noted back then was a classic bull flag pattern.
Right, bull flag, that's like a pause, isn't it? A breather?
Precisely. It's a consolidation. The stock moves sideways or maybe drifts down a bit in a kind of parallel channel. Then it uses that coiled up energy to hopefully resume the original uptrend.
And since that breakout happened, how's the chart looked?
Well, since the end of September, it's just been relentlessly strong. The RSI, the Relative Strength Index, it stayed technically overbought. That's above 70 pretty much this whole time.
Wow.
And critically, the price has stayed glued above the 21-day exponential moving average, the 21 EMA.
So when it refuses to dip below that short-term average,
It signals aggressive buyers are jumping in really quickly. It confirms there's high conviction in this trend.
so it sounds like the main job here isn't intense daily analysis, but more like just keeping an eye on that 21-day EMA and maybe managing risk with a trailing stop.
You nailed it. As long as it holds above that 21-day EMA, you stick with the trade. The chart's telling you it's working.
Okay, simple enough for J&J. But it's easy to just focus on those big defensive names. Sometimes the better charts pop up elsewhere. Let's move to number 2 in the thesis-confirmed group, Caterpillar, CAT. This was an honorable mention initially, right?
Yeah, it was, but it actually turned into one of the better performers on the list. It just shows why you keep alternatives ready.
So what happened with Singo?
Caterpillar ran beautifully right from its April low. It broke the 200-day moving average back in June. Then August was this perfect consolidation month, just a tight sideways move where it reset by touching the 50-day moving average.
Okay, consolidation. But what was the key signal there? The moment that turned it from just looking okay to, okay, this is actionable.
That was the breakout above $440. That move cleared both the July and the August highs. That was a signal the consolidation was over and the uptrend was kicking back in.
And since then?
It's just kept going. Higher highs, higher lows. It recently broke $500 a share.
Nice.
And similar to J&J, really, it's been powered by strong momentum pretty much all through October. So the rule is the same. Keep making those higher lows, stay above the 21-day EMA, and the chart's good to go.
All right, that covers the easier analysis, the confirmations. Now let's pivot. Let's talk about the two charts that really highlight why technical analysis is this ongoing day-to-day process.
Yeah.
The charts where the initial picture has changed and, well, they need a closer look.
Yes, this is where the real work offer is, and where that risk management becomes crucial.
Right.
Because every single new trading day gives you more data, and that data either confirms your plan or it starts to deny it. Your thesis has to evolve with the chart. Let's look at Broadcom, AVGO.
Okay, Broadcom. We highlighted this one because it rallied into mid-August, then pulled back, and then it gapped up pretty significantly to around $330. The thinking was that the support would likely be found within that gap range itself.
Exactly. And support, it often isn't just one single price point. It's frequently a zone, a range. We look at that whole gap area, the space between the high before the gap and the low after it, because price often pulls back to sort of fill that void before it bounces. Institutions often watch those gap boundaries.
Makes sense. So how did AVGO actually behave compared to that expectation?
Well, it pulled back almost exactly into that gap range, just like we thought it might. And we saw some really nice bounces off that zone. There was even a hammer candle testing the lower end of the range.
Okay, a bullish sign.
Yeah, and it also bounced right off the 50-day moving average, which interestingly happened to be sitting right smack in the middle of that gap zone. So for now, it is holding above both the support range and the 50-day.
But there's always a but in trading, isn't there? There's a critical line, a point where that bullish setup just gets thrown out the window.
Absolutely, there has to be. For Broadcom, if the price were to drop below $320,
Why $320 specifically?
because that would break below the recent swing lows, it would break below the 50-day moving average, and it would break below the entire gap range support. If all three of those go, that's a fundamental failure of the short-term structure. Thesis invalidated, move on. So yeah, Broadcom is really sitting at a key moment right now.
Okay, critical level noted for AVGO. Next up in this evolving thesis category, Welltower, ticker WELL. This one's a REIT, a real estate investment trust focused specifically on senior living, demographic play.
Right.
The original idea here was based on a breakout. It needed to clear the August-September resistance, which was around $170 to $180. The expectation was that level, once broken, would become the new support floor.
Oh, this is where the chart gave us a very clear and potentially expensive warning signal. It did not hold that breakout level.
Ouch. Failed breakout.
Exactly. And if you're playing a breakout and the breakout doesn't stick, you have to reassess it immediately. No hesitation.
Yeah, I know that's tough for people. It's hard to admit a train failed, especially if you bought into the story. But discipline is key.
It really is. There's a great quote from technical analyst Justin Mayes, basically. If a stock doesn't do what you expect it to do, sell it. Simple as that. Because a failed breakout, that often leads to a really fast decline.
Why so fast?
Think about it. Everyone who bought on the breakout is now trapped underwater. They're likely looking to sell as soon as they can get back close to even, minimizing their loss. That potential selling pressure is exactly why you need fast, strict risk management on breakouts.
Okay, so Welltower failed that initial breakout test. Where does it stand right now?
Well, it broke the 50-day moving average, which isn't great. But importantly, it did manage to hold the most recent swing lows. Those are sitting around $163 to $164.
So that's the last stand.
That is absolutely the last line of defense right now. Remember, the definition of an uptrend is a series of higher highs and higher lows. If those 163, 164 to lever lows give way, the pattern is officially broken. The chart's no longer structurally sound from an uptrend perspective.
Okay, that's a very clear line in the sand for well, too. Now we get to the final category. The charts that are right at the absolute point of no return, testing their final critical support levels.
The nail biters.
First is Apache, APA. This was originally picked partly for technical diversification, right? To get some energy sector exposure, so not everything looked the same.
Exactly. You don't want a portfolio where every single chart looks identical, because if that one theme fails, everything goes down together. Apache had a decent trigger back in August. It broke out above its 200-day moving average, cleared a kind of symmetrical triangle pattern.
Looked good initially.
Yeah, the initial uptrend held pretty nicely above the rising 21-day EMA.
But clearly the momentum's faded since then.
It definitely has. Breaking the 21-day EMA, that's always the first little warning flag. Since then, it's just consolidated downwards and is now trading right down onto the trendline support that connects the low from back in April and the low from August.
Okay, so connecting those major lows, this is it then, the do or die moment.
This is absolutely the do or die moment for Apache's uptrend. It's either hold this major historical trend line, or the entire bullish thesis going back months is invalidated.
What else are you watching there besides the trend line itself?
Well, ideally, you'd want to see the RSI hold above 42.
Yeah.
That suggests there's still some internal strength left. There's a neat little stock charts trick you can do here, too. If you draw that trend line connecting the lows, then drag a parallel copy of it upwards.
Ah, to create a channel.
Exactly. You can see Apache's been trading within this large, pretty consistent uptrend channel. It hit the top boundary, now it's testing the bottom. So if it holds here, this lower channel boundary could actually be a new buying opportunity. But if it breaks, game over for the uptrend. It's officially unworthy of capital at that point.
Understood. That brings us to our final chart, and probably the most volatile of the bunch, Coinbase. Coin, a direct play on the crypto space. Man, this chart must give analysts gray hair. Feels like it tests a new $50 range every week.
It certainly tests your patience, that's for sure. The original idea was based on another breakout and a gap above some short-term resistance around $345.
Okay.
Almost immediately after we discussed it, boom, a huge distribution day, a big bearish outside day that just slammed the stock right back below that breakout level.
Oof. Okay. Distribution day that suggests the big players, institutions, were selling heavily, right? A bad sign.
That's the implication, yes. Large, organized selling. Now, after that smackdown, the stock did find some support around $329. And what's really fascinating, technically speaking, is that this specific $329 level lines up almost perfectly with two really significant technical boundaries.
Which are?
The 50-day moving average and the 38.2% Fibonacci retracement level measured from the April low up to the July high.
Huh. Okay. Having two different indicators point to the same support level, that sounds compelling. But isn't there a risk of just seeing what you want to see? Confirmation bias.
That's a fair question. The key difference is looking at the price action before it hit the level. Has this area stopped selling before? In this case, yes. So we're treating the coincidence of the Fib level and the 50-day MA as adding conviction to a level that price has already shown respect for.
Okay.
You look at the volume that came in to defend this $329 area over the last week or so. It's like the chart is trying to reset its structure here, build a new base.
But what if $329 doesn't hold? What's the downside look like then?
Yeah, if this combined support level breaks, then the downside targets get significantly deeper. You'd likely be looking towards the 200-day moving average, which is way down around $280, or maybe the 50% retracement level, which is somewhere in the 295 range.
Wow, big drop potential.
Definitely. It absolutely must hold these current levels to form a viable higher low. Otherwise, the bullish structure is really compromised for the foreseeable future.
Man, this has been such a great illustration of why the technical work really truly begins after you put the trade on.
Precisely. Technical analysis, it's not some crystal ball for just picking stocks. That's maybe the easy part. Well, I've seen two charts tonight confirming their strength, doing what we hoped.
Right.
But we've also seen four charts that are challenging our initial assumptions, testing us as analysts. It's this continual monitoring, using tools like chart lists to really track how trends evolve, setting those precise alerts so you don't miss a critical breakdown. That's how you actually manage risk effectively and keep your portfolio healthy over time.
Yeah, absolutely. And we've flagged several of those really critical breakdown levels tonight. $320 for Broadcom, $163 for Welltower, that huge historical trend line for Apache, $329 for Coinbase.
And look, drawing the line on the chart, that's easy. The hard part, the really hard part, is actually hitting the sell button when the price crosses that line and forces you to admit maybe you were wrong on that one. That discipline, though, that's the ultimate payoff of using this method consistently.
So thinking about that discipline, what does this all mean for you, the listener, the learner? We really want you to apply this knowledge right away. Think about those critical breakdown levels we just talked about.
Yeah, those specific numbers.
What consistent system, or maybe just a simple alert, whether it's set up on your charting platform, maybe your broker, your portfolio tracker, what can you put in place this week to make absolutely sure you catch that exact moment a stock breaks its final support? The moment it tells you it's time to reassess.
Because that execution, that active discipline when the alert goes off, that's the work that truly moves the needle in your results.